Hi everybody, welcome back. I'm here with Steve Krieger today from Magenta Mortgage. And Steve, welcome to the show.
Hi, thanks for having me.
Yeah, of course, thank you. And today we're going to be talking about credit scores, we're going to be talking about mortgage interest and how practical real estate financing works in the residential segment. And we're going to put his information below. Reach out to him with any questions. The purpose of this video is for education purposes only. Every situation is different, so make sure you call Steve or someone else, your lender of preference, to make sure you get the right information. So thank you for tuning in. Steve,
Hey,
welcome back.
thank you.
Yeah, thank you for your time again. And this is obviously episode 2. We're going to go over how much I need for down payment. We have that question from multiple buyers in all stages of life. So this is something that we want to go over. And we just want to hear your input from the lending side and see how some of this works so people can at least take note and be okay. All right, guys, welcome back. Question number 1 is going to be, let's just kill this right now, which is, do you need 20% down to buy a home nowadays?
Not at all. Not at all.
Yeah, that's a common misconception.
I mean, you're going to get a better rate. You're not going to have mortgage insurance at 20%. But no, you don't. We can actually finance up to 100%.
Whoa.
There are down payment assistance programs, stuff like that will help offset that if you make payments on time. Mm-hmm. Interest rates aren't pretty. You can't have it all.
Right. Yeah.
But yeah, we can go up to 100% financing. There'll be a couple $1,000 probably that you have to bring in for closing costs and stuff like that.
Oh, wow.
Appraisal. But yeah, you can buy for relatively nothing out of pocket.
That's amazing.
VA is 0% down as well. So.
And sometimes they finance the closing costs, right?
Correct.
That's crazy.
Yeah.
Yeah, so we need to get all the veterans and all this. Yeah, you don't need 20%.
You don't need 20% down. And a lot of times, you and I were talking previously, there are sometimes it's a lot more beneficial to put 10 or 15% down. And that other 5%, you can buy down the rate. There's so many creative ways to utilize the same amount of money, or sometimes even less, and wind up with a lower down payment. So a lot of people, though, in their mind, they're just fixated on, I want 20% down. I don't want any mortgage insurance. But you can do a single lump sum buyout of mortgage insurance on the conventional loan. And it's a good way to just massage the numbers a couple different ways and look at all your options before you get zoned in or funneled into one particular product. Just look at the overall picture first sometimes.
Yeah, no, that makes sense. Because one of the things that we don't have that market now, but when we had last year, it was a very stable market, and we saw some properties that were in the market a little bit more than 100 days. One of the things that I advised my clients at that time is, look, this property has been sitting on the market more than 100 days. They've done 2 price reductions. Why don't we just offer this and ask for $20,000 towards buying the rate down?
Oh, yeah.
And they're like, what do you mean by that? I'm like, yeah, you can get a credit from the seller to buy your interest rate down.
Right.
It's like, oh, let's do it.
Yeah.
Because some people are not even aware of that. If you have a property that's sitting on the market, they want to sell it, then price reductions. So yeah, sometimes people are not aware of that, or sometimes those agents are not even aware of those strategies that you can do to get that deal in escrow for your client.
And side tangent, but on that same market, as opposed to even doing a solid buy down on the rate, I don't know if you've heard of temporary rate buy downs, but the temporary rate because whatever anybody has right now, you're going to refinance. There's a 90% chance that you're going to refinance.
Right.
And the majority of people right now that have a loan refinance every 18 months.
So that's the average?
That's the typical average. Every 18 months to 2 years, you're going to be refinancing, right?
Okay.
So if you have a seller credit to apply that towards a temporary rate buy down, what that is in essence is they're prepaying your interest. Okay. So they have like a 3-2-1, a 2-1, a 1-1. So a 3-2-1 means if you qualify at a 6% interest rate right now, the first year you're paying a 3% interest rate.
Wow.
So it cuts your interest in half.
Yeah.
The second year it goes up, but if you refinance prior to the end of the term, you can apply that as a principal reduction.
Oh, interesting.
So it's a smart way to utilize that, maybe the same amount of seller credit.
Yeah.
But if you're going to refinance anyway, if you buy down a 30-year loan, that money's gone.
Yeah.
But if you utilize a temporary rate buy down, you're prepaying the interest. So if you refinance, any of the money that's not used goes towards your principal when you refi.
That's huge.
So you can get a double benefit off of that potentially.
Yeah.
And if you don't refi, then you just use it all up and it goes away.
Right. That's amazing. Yeah, I did not know that. That's good to know.
Yeah.
Thank you for saying that.
Sure.
Question number 2, if someone puts down 3% instead of the 20%, what does that actually cost them over the life of the loan? And do you have some simple math that you can
I mean, it's hard because different numbers and different products and all of that stuff. Obviously, putting down 3%, as opposed to 20% is you're going to pay more interest
Yeah.
over the life of the loan because you have a bigger principal balance.
But then you have less skin in the
But
game too.
you have
right?
less skin in the game,
Yeah.
and maybe it gives you money to do improvements when you
Right.
walk into the house, right? So, and again, maybe you can do a temporary rate buy down. Maybe there are a bunch of different ways. And again, I hate to just tell people dump 20% into the property
Yeah.
without at least exploring the other options that are out there and other ways to utilize the same or even less amount of money.
Yeah.
Obviously, there are people, and there's nothing wrong with that. There are people that say, I'm getting this mortgage, I'm never touching it. I'm going to buy down as much as I can.
Yeah.
But you can only buy it down so far. Like we can't buy down to 2%. Even if you have, there's a limit to how far we can buy down.
Yeah, 'cause
usually it's like 2 discount points that we can buy down.
Yeah. Are you saying the bank still has to make money?
Unfortunately, I wish I was part of that process, but we don't make the long-term one. But yes, 100%. The bank still has to make their money.
Yeah.
But
that makes
but
sense.
there are other benefits. It's not so cut and dry as far as what are you going to save or what's going to be the difference. There's so many other different ways to skin the cat or to look at it. It's not always just numbers or just percentages. There's a lot of different variables that come into it. So.
Yeah, I know, and it's interesting. It's just, I think the basic thing that people should pay attention to is just know that the less skin in the game you have, the more you're going to pay because it's a cost of what you're
But that
doing.
might free you up to buy another property or to make investments in the stock market or do something else to make your money work somewhere else as opposed to just putting it into a piggy bank.
Yeah,
right.
Keeping it in cash, right?
Well, if you put 20% down and then in 2 years you need to do a HELOC to take that same money out, you're going to pay me again to do a HELOC for you, right? To give you back the money that you put in. I mean, just look at the overall picture before you jump to 20% down.
And also look at it like what I want to do in 2 years, in 3 years, and see am I going to need the cash in 12 months because I want to go do this.
Or do I think rates are going to go down and then I'm going to refinance when rates go down?
Right.
You just look at the whole picture before you decide 100% to put 20%
Right.
down. Or
Get
pay all
informed.
cash if you can.
I know. Yeah. Then you don't have any issues.
Yeah,
with the bank.
then none of this matters.
Right. No, that makes sense. All right. So next question. What down payment assistance programs are here in California that most buyers have no idea they exist?
I mean, it's funny with social media now and everybody's computer savvy.
Yeah.
Everybody, it seems like, knows, all the down payment assistance programs. There are thousands of them. There's tons. I mean, CalHFA, everybody knows about CalHFA. They help you out. But typically every city has some sort of down payment assistance program as well. And then I know Santa Ana has some, and Tustin has one, Orange has one. But you have to I would just go to every city or recommend people go to the city.
Yeah.
Search down payment assistance programs for the city that they're interested in looking in. There are classes. Each one is different, but there are classes that they're going to ask you to attend. Be careful though, because a lot of times it's not a free lunch. A lot of times you're going to give up a portion of your future equity by getting that down payment assistance. So just be careful of what you're getting yourself into and know what you're getting yourself into
before taking the money.
Yeah, I tend to stay away from down payment assistance programs with my clients if possible. I mean, if it's a house, and I know some people are in a position where that's the only way they're going to get a house. Yeah, and I'm not saying that the down payment assistance programs are bad. But you just want to make sure that what you're getting into, you're not giving up your future.
Yeah. No, that makes sense. You don't want the government to be your business partner in your
equity. Yeah, exactly. I mean, but at the end of the day, being a homeowner is better than being a renter, no matter how you look at it, even if you are giving up a portion of your equity.
100%.
But just know what you're getting into.
Yeah. No, I appreciate you going over that. Yeah. All right, next question. So if someone has $30,000 saved right now, should they use all of it for down payment? You gonna touch on that? Or how would you advise somebody that has, let's say somebody's out of college, they're 27, got their first job, saved 30 grand and want to buy a 2-bedroom condo. Let me pick a city, Aliso Viejo or San Clemente.
Okay.
Yeah.
Well, I would say take your 30 grand and go to the casino and double it.
There you
Just
go.
kidding.
Just Vegas, baby.
Go to Vegas, baby. No, again, it just goes back to take a look at all the options that are on the table.
Okay.
Obviously, I would say for somebody that's starting out,
you
want to put the least amount of money, like skin in the game. You want the least skin in the game as you can get because you have life. You're still probably starting your career. You probably need to make sure that you have XYZ for the month and you want to have money to do that.
Yeah.
You don't want to be house rich and too poor to put food on the table, so to speak, right? So just take a look at your life and your expenses all together and decide what's the least amount that you can, or the most amount that you can comfortably put down.
Yeah.
I'm not just trying to sell a loan for somebody.
Yeah.
Everybody can sell a loan. We all get the same rates. We all have the same products.
Right.
But the difference is developing a relationship and knowing what your client wants and being able to tailor that product for what their true needs are instead of just selling them a house, right?
Right.
Because we're not just trying to do a one deal thing. We want to be this person's resource for years to come, to where when their neighbor needs a loan or whatever, or they just have questions. So call. I want people to call me and just use me as a resource, right? So that's my goal. It's more than just a single loan, a single transaction. Yeah. It's developing something that you're gonna. I get pleasure out of seeing people succeed and build wealth and all of that stuff. It's the American dream, right? Buy a house and build wealth and family wealth, generational wealth off of starting with a condo. You can start with a condo, and you never know. The sky's the limit after that, and not just a loan.
Right. Yeah. That makes a lot of sense. But I think getting into the game is a key, right?
100%.
Get into the game as soon as possible.
Get your foot in the door. I mean, I have, just in the last couple of years, I helped my godson and one of his friends. Same thing. Started with a condo. Yeah. Use that condo, piggyback. Now they both have houses. Awesome. Use the equity to buy. Actually, my godson, we did a 0% loan for him. Whoa. And it was actually a first and a second, and then a silent third, right? And the silent third was the one that. So he literally bought his condo for like $1,500.
So he got paid to buy a condo.
Yeah. When he sold it, he made over $100,000 equity because he bought it in right around 2020, give or take.
Ooh, that was a
and
great
then
market.
and then he had a nice bump, and then he bought a huge house out in Corona.
Whoa. With
the equity that he made from the condo. So we went from 0 to hero in just a couple of years.
That's amazing. So. Yeah. He made some sacrifices, but he made
it happen.
No,
100%. Yeah. It's not sacrifice free, right? We have to put our skin into it as well. It's not just, it's not just easy peasy.
Right, yeah. It's not going to be on your lap. It just fell on my lap.
Sometimes it does, if you're lucky.
If you're lucky, yeah. But you know what? Like my godfather used to say, he's like, you know what? The harder you work, the luckier you get. But I think he got that from Arnold Palmer. But yeah, it's true, though.
True.
That's
the harder you work, the luckier you get.
Yeah, it's so true. I've seen it multiple times. I get lucky all the time. So, yeah, God is great.
Yes.
All right, so next question. Can someone use money gifted from a parent, grandparent, family member as a down payment? And how does that work?
Yes, it does. Yes, they can. Has to be a direct family member. Okay. It can't be
distant,
a friend of a cousin of an uncle.
Got it.
It's got to be like direct family. It can be an in-law, like a brother-in-law or a sister-in-law, but we have to have a direct family connection. Okay. And yes, we need a gift letter signed by the donor. We'll need to show the money coming out. A lot of times they'll ask for a bank statement. It depends on the lender that we send it to, what they ask for. Okay. A lot of times we just get away with a gift letter and then showing the money coming out of the donor's account and into the borrower's account or into escrow. I prefer to have it go straight into escrow. Okay. So it's one less paper trail that we have to
one less bank statement. Right.
So if it can just go from there to escrow, you're perfect. And it can't be mattress money. It can't be. There are a few communities that I know that they have a lot of money that they just keep cash on hand. Yeah. And it's super hard to work with, and it's super hard to trace and track.
Yeah. It's interesting you say that because we have a listing right now, and the agent submitted an offer, and we keep asking for proof of funds, and it's been a week. He can't generate. He's like, the money's in the mattress. And I'm like, how are we going to do this deal? How are you going to get the money?
But FERTA is not going to allow that either. You're going to have all of these agencies coming down on you with a cash transaction. Yeah.
Like, can you imagine this escrow is going to get flagged right away? Like hundreds of thousands of dollars. Yeah. Like, how are you going to get it in there? Oh, we can get a cashier's check. It's like, okay, where did the cashier's check come from? Yeah. Like, it's not 20,000. Yeah. Even anything after 10 is flagged, right?
Yeah. Above 10.
What if it's 600,000?
Yeah. I mean, it can be done, but you're going to have to, again, the paperwork and the paper trail and all that stuff, it's a nightmare at that point.
Yeah, I know. And some agents are not, they're just kind of, I don't know if they're not aware or they're just trying to get paid, but it's like, do you realize what you're doing? Hey, we have an open escrow. So I don't think we will. But yeah, I know it's interesting what's happening out there. All right, so next question. When is the right move to wait or to save bigger down? I'm sorry. What is the right move to make? Is to wait and save money for a bigger down payment, or just buy now and get into something with less down?
I mean, obviously, it always depends on the individual's life situation and circumstances. I'm a firm believer in now. You get in the game. Yeah. And once you get in the game, people can't take what you have away from you unless you give it up, right?
Yeah.
So I always think it's better to jump into it right now.
Yeah.
Regardless, there's a deal to be made every day, right? It doesn't matter what the market's doing. There's a deal out there every day. It's a matter of finding that deal and putting yourself in the position for it. But if you ask my opinion, I would say get in now and let the market work for you.
Yeah.
If you wait a year or 2 years, you're going to be chasing the market again. There's never going to be a perfect time. It's either the interest rate's going to be too high, or right now, like, oh, the interest rates are high, I'm going to wait for it to come down. Okay, but then you're going to be saying the price is high and I can't afford the payment. So right now, even though you get something a little less expensive and you're paying the same amount of money because interests are higher, but when value goes up and rates go down, you refinance, you're going to be paying less and have more equity. So it's always better now. And tomorrow's never promised anyway.
One of the things that people forget is the fact that, let's say you decide to move out of this house. Let's say you're living in a 4-bedroom house. You're renting it for $6,500. They send you a notice to increase the rent by $600 a month. You're like, oh, screw it. I'm out. I'm going to go rent somewhere else. Okay, that's fine. You can do that. Well, that owner is probably going to come in, and guess what? The market rate is probably better than it was when you rented.
Oh, yeah.
So they're going to crank up that property that was rented for $6,500 to $8,500.
Yeah.
And guess what? The new person that comes in is going to pay that. So landlords are not going to lose. They're going to keep cranking the rent. So then if you want to come back to the neighborhood, that property went up, which means other properties around there are going to go up.
Yeah.
So you're going to lose $2,000 a month more if you wanted to go back to that same neighborhood.
And even renting.
Right. Yeah. And you're renting.
Yeah, even renting. And for people that are investment savvy, the best hedge against inflation is a mortgage, right?
Right.
Because it's never going to change. You don't have to worry about rents going up or anything. Your mortgage is your mortgage unless you refinance.
Right.
So there is no better way to hedge against inflation than to get into the market right now.
Yeah. I think people forget, and then not only that, they don't seek advice, and then they end up in this situation of doing nothing, and then before you know it, they're like, I'm paying so much in rent. Why am I doing that? And it's like, well, you didn't.
Could have had a house. Could have, and you paid off this guy's house.
Right.
Right. So it breaks my heart when I see people renting for 20 or 30 years because they literally paid off this person's house. And is funding their retirement. And they are in a position where they have to make that monthly payment forever. And it's just a bummer.
It's just a bummer. All right, so that's it for episode 2. Thank you for your time. We'll see you for episode 3. Thank you everybody for watching.
Thank you.
We'll see you soon.